SMT is one of, if not the most important concept you need to be using in your trading. So in this video, I'm going to make sure that you master it in less than 10 minutes. SMT is defined as a cracking correlation between correlated assets. The absolute easiest way to spot SMT is by identifying a failure swing between the correlated assets. The market only turns in two ways: by taking liquidity, a breaker swing, right? So you can see right here, we take this high and then turn, or by failing to take liquidity, which is a failure swing. This is where we fail to take that high and then turn. So the easiest way to spot SMT is by identifying a failure swing on one of these correlated assets. Let's say this is ES and this is NQ. Well, once we get this failure swing, that is our SMT on NASDAQ. SMT should be used as a confluence to a pre-existing trade idea. I'm not just going and spotting any SMT on the charts, and I'm not just taking trades based on SMT. This SMT acts as a cherry on top to my pre-existing trade ideas. So I'm going to have a draw on liquidity, a narrative PD array. I'm going to have my entry model, and I'm looking for SMT to add that final confluence or cherry on top to that pre-existing trade idea. So you can see here we have our ticker. This is MNQ, the micro NASDAQ ticker. Then we have our bias of bullish, right? So we have a bullish draw on liquidity, a bullish bias on the day. We can see that tag of the weekly bullish fair value gap makes us bullish biased. We have a 4-hour internal range liquidity tag that is just a bullish fair value gap. Then we have SMT with the micro S&P 500 on the 4-hour. That's our added confluence to our bullish narrative. From there, we're looking for our entry model, right? So I'm looking for my 15-minute change in state of delivery or order flow flip entry. So do you see how I'm not just taking this trade based on SMT, but more so using it to add probability to a pre-existing trade idea? So here's two really important distinctions to make. We only look for SMT at key levels. So that's internal or external range liquidity. We only use SMT in alignment with our draw on liquidity. So if the SMT doesn't align with our current draw, it's just irrelevant, it's noise, we're not worried about it. So as you can see down here, this is our draw on liquidity. We have a bearish bias, a bearish draw on liquidity. So I'm only looking for bearish SMT, and I'm only looking for SMT on highs. So if we have a bearish trade idea, we're only looking for highs to mark SMT. And if we have a bullish trade idea or a bullish bias, we're only looking at lows to mark SMT. So you can see here, price trades into that bearish fair value gap. We have this high, and then we fail to take that high, creating a failure swing or SMT divergence. And that's an added confluence to our short towards this draw on liquidity down here. This is an example of key levels: external range liquidity, swing points, and internal range liquidity, fair value gaps. These are the only places that I'm looking for SMT divergence, literally the only places. So I'm looking for price to tag one of these key levels, either ERL or IRL, and then I'm using SMT to validate those levels. It validates smart money involvement. It's almost like a hat tip saying, okay, smart money is getting involved with price action. This is a valid reversal from the key level. We always want to be trading expansion, expanding price action, and SMT precedes expansion. SMT is confirmed by a change in state of delivery, and SMT is not considered validated until we see a change in state of delivery or an order flow flip on the aligned time frame from that key level. And we just use basic time frame alignment for this, right? So daily to 1 hour, 4 hour to 15 minute, 1 hour to 5 minute, so on and so forth. So you can see here we have SMT at a weekly fair value gap. So if this is the S&P 500, the NASDAQ tagged this weekly fair value gap, made a higher high, whereas ES failed to make that higher high. This is our failure swing, our SMT. So from here, I'm looking for a change in state of delivery to validate this as a valid SMT and confirm my short idea lower. So once we get a body close below this opening price of these two consecutive up close candles, that's our change in state of delivery, and that validates this as a valid SMT. But wait, before you just go into your charts and start mindlessly marking out SMT, you need to understand inverse and direct correlation, and you need to understand what assets are actually correlated. So this right here can act as your cheat sheet. It's a list of correlated assets in the forex, index, and commodities markets. So for me personally, I only trade futures. I do trade the currency futures, but I just trade euro and pound. So I'm using EU and GU as a direct correlation. I'm using the S&P 500 and the NASDAQ, aka ES and NQ, and then I'm using gold and silver. So now that we've ran through everything, let's hop right over to the charts to really make sure this clicks. So just to run through this again, SMT is simply one asset takes a low at a key level. The other fails to take a low at a key level. right? This is purely for a bullish scenario. We're marking out lows. For bullish scenarios, we're always marking out lows with SMT, right? So let's say that this is the S&P 500, right? This is ES right here. And then this is NASDAQ over here. We're going to assume that price trades into a key level right here, right? So a bullish fair value gap or a swing low. As we can see, ES takes this low. It sweeps the low into the key level. NASDAQ fails to take this low right here and actually makes a higher low. This is our SMT divergence, and that is your failure swing that you're going to be looking for. The failure swing is the staple signature and price that you're looking for when spotting SMT. So what we can see on the monthly time frame here on euro and pound is we have our monthly internal range liquidity. This is our key level. From here, we're looking for SMT to confirm this key level reversal and trade from internal to external up here. We're looking for a market maker model to form within this boundary right here. For us to confirm this internal range liquidity, we want to see SMT divergence form. As price plays out, we can see on this next monthly candle, pound sweeps the previous candle low, right? It makes a lower low, and euro fails to take this candle's low, creating a bullish SMT, confirming this internal range liquidity. So how do we validate this SMT and make sure that it's actually a true SMT confirming the key level? We drop into our aligned time frame, which is the daily time frame, and we look for our CISD or order flow flip. So once we tag the monthly internal, you can see on the daily, we make a low and then a higher low on euro, whereas here we make a low and then a lower low, sweeping that low. So this would be our breaker swing, and this would be our failure swing. See how we failed to take this low and we actually make a higher low. That's our SMT divergence. From here, we just need a change in state of delivery to validate that. So I need a body close above this down close candle. Once we get that, this becomes a valid SMT divergence, and we have our long idea on the menu. So this is now a valid SMT divergence. I usually set my limit order right at the order block or at the fair value gap that gets created. So we'll see what happens here. Okay, we created fair value gap. I'll set my order right here at this gap. Target 2R in the direction higher of my draw on liquidity. Let's see if we get tagged in. Boom, we get tagged in. Actually hits the CISD to the tick. Beautiful. Now we target 2R and we just let the thing work. Run straight to PT. Beautiful longs off of this internal range liquidity, validated by the SMT divergence. That's how we use it. Simple, right? So all you're looking for is this signature and price. One ticker making a lower low at a key level and the other making a higher low. That's for the bullish scenario. For the bearish scenario, you're just looking for the inverse. If we trade into a key level, one ticker is going to make a higher high, whilst the other should simultaneously make a lower high, right? So that's your SMT, and this confirms the key level. So that's it. You've mastered SMT in less than 10 minutes. You always want to be using SMT with a current draw on liquidity. So if you don't understand draw on liquidity, definitely check out this video right here.